Today we are focused on the foreign tax credit claimed on Form 1116, which is designed to relieve the burden of double taxation when foreign source income is taxed by both a foreign country and the United States. The exam will test your understanding of whether to take a credit or a deduction. A taxpayer can choose to deduct foreign income taxes as an itemized deduction on Schedule A, but it's almost always better to take the credit. A deduction only reduces your taxable income, while a credit reduces your U.S. tax liability dollar for dollar. The exam loves to present scenarios where you must identify the better option, and the credit is the high-value choice. A critical point tested is what constitutes a creditable tax. Only foreign income taxes or taxes paid in lieu of an income tax are eligible for the credit. Be careful with trick questions that include foreign value-added taxes, sales taxes, or property taxes. These are not income taxes and therefore cannot be claimed as a credit, although they might be deductible as a business expense. The amount of foreign tax credit you can take is subject to a limitation. Your credit is the lesser of the actual foreign income tax you paid or accrued, or the U.S. tax liability on your foreign source income. You cannot use foreign tax credits to offset your U.S. tax on U.S. source income. The formula for this limitation is your foreign source taxable income divided by your total taxable income from all sources, and then that result is multiplied by your U.S. tax before credits. The exam will require you to apply this limitation concept, often without needing a calculator, by understanding which amount sets the ceiling. Furthermore, the credit must be calculated separately for different categories of income. The two most common categories you'll see on the exam are passive income, like interest and dividends, and general limitation income, which includes wages and active business income. The exam will test your ability to keep these categories separate. For instance, if you paid high taxes on your foreign wages in the general category, you cannot use any excess credit from that to offset U.S. tax on your low-taxed foreign interest income in the passive category. It must be calculated independently on separate Forms 1116. If your foreign taxes paid exceed your credit limitation for the year, the excess is not lost. The exam will test the carryover rules precisely. You can carry the unused credit back 1 year and then carry it forward for up to 10 years. A common exam question will give you a scenario with an excess credit and ask what the first or last year is that the credit can be used. Just remember this simple phrase: go back 1 time, then move forward 10. This ensures you never miss a question on the carryover timeline.